Hello and welcome to this mini seminar on the First Home Buyers Help. The reason I've put this together is that over the last 12 months I've done a lot of filming and case studies and interviewing people, and rather than just all whacking it onto a DVD, I wanted to have a bit of structure behind it, plus add in a few more hints and tips. To get started, I'm going to talk about the interest rates. Recently we've had another interest rate rise, which is probably worrying a few first home buyers. The good news is though, if you're not yet in the market, it's not such a bad thing. The reason for that is that it affects everyone in your same price bracket range. So for example, if you had a pre-approval for a loan of $300,000, that may drop a little bit to $290,000, but it also drops everyone at that $300,000 range. So you're not actually disadvantaged in some ways. If anything, housing prices may have to drop to be able to meet the people that can actually afford to buy those types of houses. On the other hand, once you have a mortgage and you're in the market, you're at the mercy of the interest rate rises. So if you're paying 8% and it went up to 8.25, you might be having to pay an extra $500 a year. And then if there's another interest rate rise, that's another $500. So getting into the market a bit later on after the rises have happened may actually cause pricing houses to halt a bit, and you'll be able to control a bit more your repayments. I talk in the course manual about what should you borrow against what can you borrow. And I think this is the absolute key to your success in buying your first home and becoming financially secure along the way. You may have noticed the graph. If you're able to borrow $300,000, you're probably better off borrowing 5% less, or if you really can, 10% less, and still making the same repayments as if you'd borrow $300,000. That way you'll pay off your home loan years in advance, as well as saving literally tens and thousands of dollars. Another way of looking at money is, if you bought a $300,000 house, and it's going to cost you $600 over the long run, why not buy one for $285, be able to make these extra repayments, and it may only cost you $500. So sacrificing that $15,000 up front at the other end may save you over $80,000. This is another thing to think about. The third thing on interest rate rises are, how many can you actually handle? As mentioned, one interest rate rise may equal $500. The second interest rate rise may be another $500, as well as the third. So by the fourth interest rate rise, which may be a full percentage point, you may have to sell the house at about what you paid for it because the market would have halted due to the other buyers not being able to afford with the interest rate rises. So you would have lost in the meantime, instead of $500 at a time, once that big hit comes, you're going to lose your whole investment as far as the stamp duty, lender's mortgage insurance, and maybe up to $20,000 that went into the house as part of start-off costs, which you can't actually recover. And that's where it really hurts. I'm not trying to scare you here. I just want to make sure that you are the most informed you possibly can be when getting into your first home. The good news is that 95% of people will never have a worry. But I just want to make sure that you're not in that 5% that probably just overextend themselves a little too much. I'll tell you a story about when I was looking to vendor finance a client up in Morwell. What vendor finance is basically that I'm the bank. I get a loan and then I loan money to other people. So it was a really good learning experience for me to see how a bank operates, because effectively I had to play that role. With my client, I approved him for a loan of $85,000, and that was great. But when I went up to Morwell a few times to have a chat to him, and he was showing me houses he really liked, any house he really liked cost $115,000 or more. And I said to him, look, that's $30,000 more than you can actually afford to borrow, or otherwise you might move into this home, default from repayments, and no one wins. And that's how you've got to look at it, that no one wins. In the end with this client, unfortunately, I had to walk away because he just didn't quite understand what he was getting himself into. And I wasn't prepared to take the risk for either myself or for him. And that's how banks look at you. One thing with borrowing though, is that banks often just tick the boxes and get a yes or no, depending on what their system says. I'll give you an example of my little sister who just got a personal loan. She ticked all the boxes, sent in an online application, and got given a no by the bank. So then she went to another bank and the same thing happened. And I said to her, there's two key questions that you have to ask if you do get rejected. Number one is why. So that makes them look into your application a bit further to see exactly why you don't qualify for the amount that you're hoping to get. And number two, how much can I actually borrow? Because the fact is, there always is going to be a number that you can borrow. Whether it's as high as you'd like it to be is another thing. At least if you have that starting point, you'll be able to make some changes to your finances now potentially and increase your serviceability. If you have a look in the course manual on the chapter of finance, there's some great tips in there which you can look at right now to try and improve how much the banks will actually let you borrow. Moving on from interest rates, when you get into the property market, obviously one thing you have to do is deal with a lot of people. The main people you're going to have to deal with are mortgage brokers, real estate agents, potentially vendors. What I've found though is when you get started is it can be pretty nerve-wracking. You're not sure what questions you ask, you don't want to look stupid, but at the end of the day, there's no such thing as a stupid question. One of the very first steps is to find a mortgage broker that understands your needs. Make sure that there's no excess fees at the end, there's a good interest rate, and that the loan is really tailored to your needs. That's the advantage of a mortgage broker, is they've got access to a lot of different products, and therefore they can tailor a loan to your needs better than a bank probably could.